שלום לכולם וברוכים הבאים למפגש הזום של חברת סקייליין, לסקירת עסקת מכירת רוב אתרי הנופש ונכסי הייזום של החברה בקנדה. אנחנו מזמינים אתכם להעביר שאלות במהלך השיחה דרך ה-Q&A של המערכת או אליי לנייד, אביור מקשרי משקיעים. המספר מופיע בחתימה של המייל שפרסמנו, ניתן לשלוח גם לעודד בן חורין. אם ברצונכם שיציין מי השואל, ציינו זאת בבקשה בהודעה ששלחתם. לפני שאני מעביר את זכות הדיבור למנכ"ל החברה, ברצוני לציין כי מלבד נתונים היסטוריים שימסרו, כל הנתונים ו/או התוצאות שיוזכרו בשיחה זו הינם תחזיות עתידיות, הכוללות סיכונים ואי ודאות. תוצאותיה של החברה עלולות להיות שונות באופן מהותי בשל גורמים שונים, כפי שמפורט בתשקיף החברה ובדיווחיה לרשויות. שיחת הוועידה אינה מחליפה את הצורך לעיין בדוחות התקופתיים האחרונים, בהם נכלל המידע המלא לרבות מידע בהתאם לסעיף 32א לחוק ניירות ערך, מידע צופה פני עתיד. את הדיסקליימר המלא, כולל הדיסקליימר הקנדי, ניתן למצוא במצגת החברה. אני מעביר כרגע את רשות הדיבור לבלייק. Blake, you're welcome to start.
Okay, thank you everyone. If you could turn to the first page then. Great. So thank you everyone for joining. We're excited to review this transaction with you that we announced a week or so ago, just to give you a bit more specific information on the transaction and answer any questions that you may have. So as you've seen, Skyline announced that it's sold. Basically, it's resort properties in Canada, Deerhurst, Horseshoe, and Blue Mountain, the lands of Blue Mountain, for a total amount of $210 million. And this was sold to Freed Corporation, which is headed up by a gentleman by the name of Peter Freed, who's a local Toronto-based real estate developer and hoteler. He's done quite a few things in Toronto and owns a resort property near our two properties, Deerhurst and Horseshoe, which we'll tell you a bit more about in a minute. The $200 million transaction is one of the largest transaction in the resort community, Canadian resort community, in probably the last 15 years. So we're delighted that we were able to get this completed. The sale is approximately $30 million more than our fair values, which we'll review with you in a minute as well. And for those of you who remember, we do fair value accounting on our books. And so achieving something beyond the fair value, in this case, $30 million on a $210 million transaction, we're quite excited that we were able to get that kind of a gain on top of our fair values. It represents approximately 28% of the total assets on our balance sheet as of June 30th. And this is something we've been talking about for several years now, about specifically reducing the land component in Skyline. We've done that previously with other sales, and now this is a pretty significant completion of the sale of most of our lands in Canada. And doing this and getting it done during the pandemic of COVID, we're quite excited. It really does reduce provides us with a significant debt reduction on these hospitality assets and gives us some excess cash at a time when looks like we're exiting COVID, and we can talk a little bit about the uses of cash. But to get this pulled together during the pandemic, as you can imagine, a lot of moving parts in the transaction, and getting Freed getting his debt together to be able to organize and move forward with this transaction has been a lot of work. He has now put forward $7 million of non-refundable deposits with our lawyers, and he's quite focused on getting this transaction done, and is very committed, has his bank financing in place, and we're just at this point moving towards a closing scheduled to be at the end of October, which is really only a month from now. So he does have two extensions in there, two 20-day extensions that's really geared specifically around if the banks themselves aren't ready to fund because they need a bit more time. So that's why we put those in. But everything is moving at this point towards the end of October. We're very excited. There's going to be some reduction in our corporate costs as a result of this. The development team that was managing our land assets will be moving over to Freed Corporation. This was headed by Paul Mundell, who's one of our senior executives. And so Paul will move into the resort limited partnership, him and his team, which will give some continuity to the structure and to the land development that will carry on but specifically under the Freed Corporation headed by Peter Freed. You could just go to the next page. So it's $210 million transaction. There's $109 million of cash that we would receive on October 31st. Of course, we've got $7 million through the deposit, so it's really $102 million more would come in on closing. And then there's a $60 million vendor take back that will come over to us in the next 4 years with an annual interest rate of 5%. And that vendor take back, or VTB as we short form it, is secured by the second mortgages on the Deerhurst, Horseshoe, and Blue Mountain land. So there'll be a first mortgage that Peter will have on each of those 3 assets, and then will be a second behind that with an overall leverage of not more than 75%. And then we have another general security agreement at the resort LP level, which gives us a bit more asset protection as well. We'll then have about $33 million or 29% of the combined entity as an equity investment going forward. So we'll take back a little bit of ownership on a minority basis. This will give us basically a 29% continuing interest in our 3 properties plus Muskoka Bay, which is the resort property that Freed owns today. So this gives us a little trail and a little upside potentially in going forward, but without the significant continuing investment that we have today. But Freed does have has an option that he could, under his call option, buy us out between now or between closing and the end of 2022. And he can do that by simply paying us the $33 million plus a 12% interest rate from the time he closes to the time he would pay us. And that's a call option that will expire at the end of December 31st of 2022. If that's not triggered, then our equity continues on further, and then we have the ability to either put to him 50% or half of our ownership in year 4 and 5 to totally exit, or he can actually buy us out, by giving us 50% at the time in year 4 and 50% in year 5. And that's all done through a fair value formula that's built into our agreements. So we could, in theory, have 100% exit at the end of the 5th year, and possibly at the end of next year if he triggers the early option. Muskoka Bay Resort, we've got a roll-in value that we negotiated with Freed as part of the transaction. This resort is 869 acres, so it's a similar size to Deerhurst that most of you would know. Newly built, significant 17,000 square foot clubhouse that you can see there on the picture. If you could just go back first, yeah. And then he's recently built a new hotel that you can see there in the bottom, called Muskoka Bay Resort Hotel. and it's a combination of owned units and rental units, similar in structure of the rental pools that we have at Deerhurst and Horseshoe. And then, of course, he's got all the lands that go with the property and significant development rights attached to that. And then he's built a significant high-end, difficult golf course called Muskoka Bay Golf Course. It's ranked number 7 in Canada by the one of the leading golf course companies that provide these rankings for golfers out there. So this is a pretty strategic thing that he's going to build around, really, for the sale of the resort of the land, and the selling of more condos and homes in the area built around the brand of this particular golf course. And it's located between, sort of halfway between Horseshoe and Deerhurst. It's about 2 hours from Toronto. We do have, as part of the resort limited partnership structure that's been put in place, while we're a 29% minority partner, we do have certain voice and approval rights that we put into the structure, just to allow us some protection as a minority. So including the right we have to approve acquisitions, dispositions, issuances of equity, and issuance of new debt. So that just gives us a good working relationship with Peter Fried and some protection as a minority. And then there's some normal tag along, drag along provisions, and probably most importantly, we don't have any obligations for further additional equity. We can if we want to, but it's totally discretionary from our perspective, and there's no commitments on our part. So this is just a slide that a little bit more detail, showing you the components of the asset values versus our fair values. You can see that ultimately there's about $32 million of gains that'll come through our books, sort of somewhere. It'll come in part through our income statement and in part through the comprehensive income statement, or OCI, as our accountants call it. And either way, that will flow through ultimately into our equity, and we're pretty excited about what that'll do to our NAV, which we'll talk to you in the next slide or two here. So I'll get Rob Waxman, our Chief Financial Officer, to review a few more of the details around some of the components in the purchase.
Thanks, Blake. Excuse me. What I'd like to do is focus your attention on the left side of this slide, really to break down the components of the deal, trying to lay it out so you can see what's coming in and what's going out. So the purchase price on the top left side, $210 million. We have a VTB of approximately $60 million. There's the equity deferred, or the equity investment that we're retaining in the resorts of $32.7 million. And a bridge loan of $8 million. Those are from a high level, the components, and then that leaves us with our cash on closing of $109.3 million. The VTB is significant at $60 million. And so what we've laid out here for you is the timing of the principal repayments. February of 2024 is 28 months after closing. Obviously, if closing happens a month later, then all of these dates would get pushed out by a month. But this is all based off of an October 31st closing. So $10 million coming in month 28, $25 million coming in month 42, and then the balance coming in month 48. Total interest payments over the life of $10.5 million, which will give Skyline a total of $70.5 million of cash over the next 48 months. On the right side, we break down the capital stack, and just to point out, there are our VTBs. Our VTBs are secured by the 3 properties that we're selling, The third-party VTB you see here in the bottom right side from the third party for 19.2 million actually relates to a group that is being bought out of Muskoka Bay, and they have a VTB back to the Freed Corporation for 19.2 million, and it is secured by Muskoka Bay only. So I just want you to understand that there are other VTBs built into this, but we only have security over properties that we're selling, each of the groups. We can go to the next slide. So what we're trying to show here is that we've got about $189 million coming in over the next 4 years, and how that money comes in. As we've said, as Blake said, we do have a put option. Peter has a call option in years 4 and 5 for up to 50% of the equity. So that could bring in additional funds at those times. But that's not depicted in here as we run through this. So as you can see, on closing, $109.299 million. If we work our way down that first column, we add in the bridge loan, the VTB, and the equity, and there's your $210 million. In year 1, we'll earn about $1.5 million in interest. Year 2, that interest will continue at 1.5 million, and the bridge loan will get paid back in year 2, plus a 12% preferred return on that bridge loan. In years 3 and 4, we start returning the VTB and interest on the VTB at higher rates, or sorry, not higher rates, but the deferred portion of the interest will get paid in year 3, and then continuing on, we get full interest paid on a cash basis quarterly. So you can see the $10 million coming in year 3, and then the full amount of $50 million coming in year 4. That's months 42 and 48. We can go to the next slide. So again, we wanted to break down what happens with that $109.3 million that is going to come in on closing. We've announced in the press release that we'll be repaying Bond A. The formal IR is anticipated in the next day or two. It's just with the TAS and the bond trustee for their approvals. We've got the line of credit, which we announce each quarter how much is drawn on it. That repayment will be $16 million. That's secured by Horseshoe, so it will go away and be no longer available to us. We have a minority partner in Blue Mountain, so they will get $5.5 million for their share of the cash that's getting paid back. There's some repayment of other loans on some small pieces of land that are Deerhurst and Horseshoe of $4.2 million. The tax holdback here of $2.9 million is strictly related to taxes that we have to pay on the sale of Blue Mountain. We don't have any tax shelters or tax strategies that we can employ in this structure. And so with our joint venture partners, so we do pay full tax rates of about 26% at Blue Mountain. We will pay on certain portions, we pay 26%, and on other portions, which are considered capital gains, we have the tax rate, excuse me, is 13.25%. And then we've got additional closing costs, legals, commissions, and some other costs that we'll have to pay out, leaving us with about $30 million of net cash after at closing that we can use for additional acquisitions, which Blake will go through in a few minutes. If we can go to the next slide. This is our pro forma net asset value slide. It's a slide you see every quarter in our corporate presentation. The orange component was going to work. I'm going to work through the top of this slide and then down afterwards. But the orange part is the Q2 2021 slide that you've seen. It's all based off our financial statements at Q2. So nothing we're talking about includes Q3 and the results of Q3, which end today and will be published in mid-November. So at the end of Q2, we had an NAV of 36.24 shekels. You can see that in the second column right at the bottom. And then what we tried to do is to layer in this transaction into that NAV slide and that NAV calculation to show you the growth in NAV with just this transaction alone. And so you'll see that there's a reduction of the Horseshoe and Deerhurst assets, obviously because we're selling them. We show you the leverage that are still left in the remaining assets. There's no leverage on Bear Valley, and then as a company as a whole, we continue to maintain a low leverage scenario. We take out the various pieces of lands at Horseshoe, Deerhurst, Blue Mountain at their cost base. And then we add in, as you can see, moving down the slide in this blue section, $30 million of cash, the $59.9 million of VTBs, $32.7 million of the equity, and the bridge loan of $8 million. The reduction of receivables and others, that's mostly just a change in working capital because we don't have the cash or we don't have the receivables and payables and inventory. They get removed from the operating businesses of Horseshoe and Deerhurst specifically. And so as we move down and through the slide, what you'll see is that our NAV will go from 36.24 at the end of Q2 up to 40.17 as a result of this transaction. That's an almost 11% increase in our NAV as a result of this transaction alone. I think we move to the next slide. I'll pass it back to Blake to conclude the presentation.
Okay, great. Thanks, Rob. So this is our strategy slide from our corporate presentation that we do every quarter for you. No surprises there. I mean, this again, our strategy has been, we've been telling you for a while that we wanted to remove capital from the land assets specifically. And in this case, we've basically gotten ourselves out of the land almost entirely, and also are taking significant capital out of the resorts themselves. We intend to reinvest. Our strategy for new acquisitions. You're well aware we are looking in the U.S. and Canada. Some people have asked us, made the comment, are we leaving Canada? I mean, the answer is clearly no. We will be certainly not holding any direct properties for the time being, but we certainly love Canada and we'll continue to see what we can find here for acquisitions. There's clearly more, as you can imagine, acquisitions in the U.S. There's also just better lending ability. So we see more deals, more interesting deals in the U.S., but that formula can change over time. And I think we will continue to watch both Canada and the U.S. and just sitting in Toronto, we naturally see most everything that's available in Canada. We're looking for stabilized income, looking for places that have got good growth potential, good demand generators. We look at supply and low seasonality, and the big one is really acquisition cost below replacement cost. That's one we certainly focus on. So we're actually, Rob and Ben and myself are in Phoenix, Arizona right now. It's midnight here. We're excited because we're at the lodging or hotel conference. It's really been the first major one since COVID came. So lots of excitement, 2,000 people. I'm sure you're all aware of some parts of the US. I mean, you wouldn't know COVID exists here. People are very excited. We're, lots of interesting and sizable deal flow coming back into the market. We've, in some of my discussions with you, some of you in the past, we've talked about, what was out there through COVID, and there really wasn't a lot out there through COVID. We weren't a buyer. We were conserving our cash, but clearly people were, the banks were being accommodative, and we weren't seeing a lot back then, but we're starting to really see it now. People coming to the market, the banks are coming back into the market, and there's an energy that we're seeing. That also means we got to go through a lot of deals. I mean, we're going to take our time. We're going to look for the right asset. We're going to find the right debt to match it to. But we're excited that with the cash that we're going to see coming out of initially out of this transaction, and then more cash coming out through the vendor take back as it gets repaid. We just think it's a good time for Skyline, and we think there'll be some good opportunities to redeploy the capital. So on the next slide, we just gave you a little bit of snapshot of kind of what just what it means for our initial cash flow. So we get about $2 million right now when you look at the NOI from the Deerhurst and Horseshoe, less the debt service, which is mostly the bond A, and then we have CapEx that we would put into the resorts on a annual basis. So there's about $2 million that comes out. So we will actually replace that cash flow directly with just simply the interest from the VTB from the Freed deal, plus the savings from the corporate costs that we'll save with Paul's group going over to Freed. So then as we start to deploy and reinvest the 30 million of capital, which in sort of using traditional examples, you can generally get 65% loan to value. So you can basically multiply that by 3, or more specifically to $86 million. And that's what we sort of ran a schedule showing the different cap rates that we think we can find interesting deals around 8, 9, 10% cap rates with the requisite interest rate on the debt. So we think we can multiply that 2 million by upwards of 3 times just with redeploying the equity of the $30 million. And then there'll be more. The sort of the more exciting part is as the next 80 million comes out from Freed. Again, you can kind of sort of round numbers, multiply that by 3 to figure out how much we can go shopping with. And that's sort of somewhere around $228 million of additional assets that we can go and purchase. And of course, these are the kind of cap rates that we're just showing as an illustrative cap rate. It'll just drive further cash flow and FFO to the company as we would move forward. The share price to discount to NAV. This is something we put in our corporate presentation for you all as well. I mean, this is something that we watch. Obviously, we've been more an NAV company versus something trading specifically off of earnings and cash flow. That's, as you know, we've been sort of repositioning, realigning Skyline for the last several years, growing the income producing side of things and the cash flow, but really driving towards moving the net asset value up over time and through various releases of asset value based on what we've been doing, whether it's investing into the properties to grow the NAV or buying the courtyards. You saw us buy the courtyards and use good leverage to do that. And now with this transaction, this will get us over 40 shekels a share in NAV, and our share price is not following suit as yet, but I've always been brought up with the under the school that you run the business and do a good job running the business, the share price will figure itself out eventually. So hopefully that's the case with this slide. I think it will be. And then in closing, so I think we're pretty excited about this transaction. We're very excited about this transaction. It's been in the works for a while, as you can imagine. It's not a insignificant transaction. I met Peter Freed probably over 2 years ago and started to get to know him, and then we started to figure things out, and then the deal started to take shape a while ago as we put everything together. We're excited. This is going to this was what we told you we would do as far as monetization. This is going to allow us to diversify further the company, which we did. We went a long ways with the acquisition of the courtyards, and this will allow us to take some seasonality out of our business and further diversify the asset base. Getting this kind of value in this kind of a market, it's not been the best of years, best 18 months, give or take, for any of us. But obviously our industry in particular felt the COVID. The good news is everything is bouncing back very nicely, and we're seeing the occupancy, really come back across our properties, which you would have seen in our Q2 numbers. The equity roll, or the equity take back that we have with Freed, the 29%, that gives us continuing small investment in the sector, but without the bank guarantees, the capital commitment, and direct management. All the employees move over to Freed, and we have he takes on all the bank guarantees, and we have we don't have any of that. We're a minority investor, and we'll be able to still hopefully see some good upside as we move forward, but still have a little bit of exposure, but we're able to take a lot of capital out. This will immediately lower our debt, so our balance sheet will shrink initially as we pay off a lot of the debt, increase our cash reserves, but hopefully we'll start to expand back up as we redeploy the cash into 2022 and buy new properties and take on some additional moderate leverage associated with those acquisitions. And as I said, this is going to be increasing our FFO over time, and which is very positive for the company. And really, I think I see this as a game changer for Skyline. I think it lowers the overall risk profile of the company, and really sets us sets us up at a time when it looks like COVID's going in the right direction, and we're going to have some extra cash, so we're pretty excited. I think those are my remarks. I think it's probably time for some questions.
Thank you, Blake. We received a variety of questions. I just want to mention that you are welcome to forward questions in Hebrew or English through the Q&A or direct to us. First question.
So the first question, Rob, maybe you'll take it, is about the owner's loan, which is secured by a second mortgage. The question is, it going to be reevaluated?
Well, the loan itself has value, and it wouldn't get revalued down, and you don't value loans like this upwards. We expect to get paid, and as long as we expect to get paid, the balance that we're receivable will sit on our balance sheet as a receivable. So like any of our VTBs, they have all been repaid on time or early. As example, we did get $16 million back this summer, which we spoke about in our Q2 release. And so we have no expectations that this would be any different.
Okay, thank you.
I hope that answers the question.
Yeah, I think it did. Another question we got was earlier in the presentation was about your intention, what to do with the proceeds from the sale. I think, Blake, you spoke quite a lot about that. Unless there's something you wanted to add, maybe we can move to the next question.
Yeah, I mean, we can't say specifically. I mean, we, as I said, we're seeing interesting things. We didn't want to get ourselves too far out until we knew when this was going to, if it was going to firm up, and of course when it's going to close. So you can't spend money before you get it. So we've now that we think it's coming, we can start to put our hand up there. And timing of the conference, as I said, was interesting, fortuitous almost, and we really see the market is changing, and people's belief that COVID is moving on. It's interesting. A year ago, there was lots of discussion, disaster discussions. Would people travel again? Buffets, would they ever come back? I mean, it was, Rob and I had buffets served to us all weekend here. not that I'm saying it's the best thing at this point, but people are very liberal here with the COVID, and so it's really bouncing back, and people are moving around, and that creates is creating, I think, a good environment for people to feel good about the hotels, and that things are going to come back. I think I said a year ago when I was chatting with some of you that I remember back I used to be in the e-learning business, well, a long time ago when it was first coming out, online learning, and I remember people saying, this is going to replace classrooms, and it never did. And when people said COVID's going to stop people from traveling, I just firmly believe that's not the case. It's a temporary thing, and we're really pushing through it, and that's really starting to show up in some of the opportunities, I think, that are coming.
Another question, do you guys intend to do a buyback, taking into consideration the low share price?
I think that's something that the board will always look at. We've got to get the transaction closed. The board will obviously be looking towards management to sort of decide where the right place for investment makes sense. Clearly, there's it's compelling, as we've shown you in that slide, the potential gain there from the NAV versus the share price. So obviously, no decisions been made. The board will consider it, I presume. And if something comes forward, obviously it would be announced at that time.
One question regards about Freed, if you can elaborate a bit about them, since they're not so familiar in the local market with them.
Yeah, he's a major developer in Toronto. He's built a number of skyscrapers. He's built the Thompson Hotel in Toronto, which is a very high-end hotel. He just bought a 300-room hotel, which is actually going to knock down as part of a redevelopment in Toronto, in downtown Toronto. He's owned Muskoka Bay for 15 odd years, and has built the golf course, just launched his first hotel there. He's well known to a couple of our Canadian directors, and I certainly knew about him and watched him through, just because he's bought some landmark properties in Toronto, and young guy, pretty young. He's low 50s, and a lot of energy, and good contacts, good capital. We've got to know a few of the capital providers behind him, and he seems pretty solid, and he's done quite a few things specifically in Toronto, and north where the resort is. So I think there's freecorp.com. You can go and have a look there, and get a bit more information on him. He's a pretty nice guy.
Thanks, Blake. Next question. Don't you think that given the uncertainty associated with COVID, it would be prudent to hold off new acquisition and use the funds to reduce leverage?
Well, that's what we're doing initially. We're paying back debt. That we'll pay back the bond A. We're going to pay back the line of credit that we've got, which is secured against the Horseshoe. There's a few other debts that get paid off. We're not saying we're rushing out there. I mean, we didn't do that with the Courtyards. We went through over $2 billion worth of transactions. I remember that number in my head. I remember the spreadsheet that Ben and I used to go through of all the deals that we ultimately went through to find it. I mean, you've got to. So I mean, yes, we have to watch and see what happens with COVID, and take it seriously. We've done that all the way through, and I think we'll continue to watch that. But it's at the same time, I think we'll just naturally be in the market looking around to see where it might make some sense for us. But I think we've always been pretty conservative in our balance sheet. We're conservative in our balance sheet coming into COVID. We had low loan to value versus our peers, and I think that's why we were able to push through COVID and maintain our Baa1 rating with Midrug. We were delighted that they never did a downgrade with us. We were put on the warning, the watch, I guess, through the process. But we've maintained a pretty conservative, measured balance sheet, and I think just management philosophy, both going into COVID, through COVID, and we'll keep that going post COVID. So we're mindful of COVID, and we'll see what's out. First, right now, we got to get the transaction closed, money in the bank, pay down our debts, and then we'll work with our board going forward on what makes sense.
Thank you, Blake and Rob. No more questions at this point. I will be switching to Hebrew for one last mention. מי שמעוניין בפגישה עם החברה יכול לפנות אלינו לקשרי משקיעים. כמו כן תוכלו למצוא הקלטה של השיחה באתר החברה. Blake, you're welcome to give your closing remarks, if any.
Well, thank you all for the participation. We certainly hope to see you in person in Israel. Ben was there recently, and Rob and I and Ben will be back hopefully the next few months here. We'll start to re-engage with the in-person discussions with all of you, and we're excited with this transaction. We'll keep you all abreast of any changes if there are any, but we expect this thing to close on October 31st, or that's a Sunday, so it's going to actually be the Monday, it looks like. And so we're excited. This is a big deal for us, and a big deal coming out of a very tough time in our industry. So thank you for the time, and any other questions that come up after, you can get a hold of Rob or I or Ben. Please reach out. We'd love to hear from you.